Control doesn't disappear all at once. It slips. 1 second your trades feel clean, the next you're chasing losses, second-guessing entries, and wondering what just happened. If you've ever watched a good trading day quietly spiral into chaos, you know exactly how fast this can get expensive. Here's the uncomfortable truth. Most traders don't lose because of bad strategy. They lose in the exact moment control quietly breaks. And the scary part, you usually don't notice it until the damage is done. In the next few minutes, you'll learn how to spot the slip early, stop the bleed, and protect your edge before it's gone. I have seen many men lose money in the market, and most of them never knew the exact moment it began. They thought the loss came from the last trade, the bad news, the sudden move. But the truth is simpler and far more dangerous. Control does not vanish with a bang. It leaks away quietly while a man still believes he is thinking clearly. Have you ever felt that shift? 1 minute your hand is steady on the mouse, your plan is clean, your risk is measured, and the next minute you are clicking faster than your judgment can keep up. That is the moment I am talking about. That is when the market stops being a place of opportunity and starts becoming a place of tuition. In my time, I learned that the market itself rarely surprises the prepared man. What ruins him is the small crack in discipline that he ignores. The chart may still look the same. The price may still be within reason. But inside the trader, something has already moved out of position. You see, trading is not merely about reading charts. Any clerk with enough time can learn where support and resistance lie. The real business is reading yourself while you read the tape. Because the market has a way of testing a man's patience long before it tests his method. And when patience weakens, control soon follows. Tell me, have you ever added to a position you promised yourself you would cut? Of course you have. Every trader who stays in this game long enough faces that moment. It begins with a simple thought. It will come back. That little sentence has emptied more accounts than any bear market in history. The dangerous part is that it feels reasonable at the time. Your chart may even give you a small excuse. Price is near support. Volume looks acceptable. The story you tell yourself sounds almost professional. But deep down, if you are honest, you know the decision was not made from strength. It was made from discomfort. That is how control slips. It does not happen when you are calm and patient and following your plan. It happens when you are slightly irritated, slightly eager, slightly unwilling to accept a small loss. The market senses this weakness the way the ocean senses a crack in a ship's hull. Slowly at first, then all at once. In my early days, I paid dearly to learn this lesson. I thought the game was about being right. Most beginners do. They believe if they can just predict the next move, the money will follow. But the market does not reward prediction nearly as much as it rewards discipline. A man can be wrong half the time and still grow wealthy, provided he keeps control when it matters most. But what happens when control slips? Your position size quietly grows larger than planned. Your stops get wider or disappear altogether. Your entries become faster, less selective. You begin trading not what you see, but what you hope. And hope, my friend, is the most expensive indicator ever invented. Have you noticed how quickly one emotional trade attracts another? It is never just one. The first lapse opens the door. The second trade walks through it. By the third, the market is no longer your opponent. Your own impulses are. This is why I always said the big money is not in the buying and selling. It is in the waiting. Waiting keeps a man in control. Waiting keeps his judgment sharp. But the moment he feels he must act, must make back what was lost, must catch the next move, that is when the market begins to collect from him. There is also a matter of money mindset that few care to examine. Many traders say they want to build wealth, but their behavior tells another story. Wealth grows from consistency, from protecting capital, from thinking in probabilities. Yet when control slips, the trader starts thinking in single trades. He begins gambling for emotional relief instead of positioning for long-term gain. Let me ask you something plainly. When your last trade went against you, did you immediately look for the next setup? Or did you feel the urge to get even? Be honest. Because the market has no mercy for traders, who are trying to settle emotional scores. The charts themselves often give early warning signs, not just about price, but about your behavior. When you find yourself forcing entries in mediocre ranges, when you start ignoring clean breakouts because you are stuck in the last loss, when your risk per trade quietly creeps higher than your written rules, these are not market signals. These are personal ones. And the professionals, the ones who survive long enough to compound real wealth, they respect these signals more than any indicator. I learned to step back the moment I felt that internal pressure building, not because I was afraid of the market, but because I knew the market was about to test my weakest point. There is no shame in standing aside. The shame is in staying at the table after your judgment has already begun to fog. You must understand something clearly. The market will be here tomorrow, and next week, and next year, but your capital, and more importantly your confidence, can disappear much faster if you allow control to slip repeatedly. Most traders think their edge lies in their strategy. Sometimes it does, but more often, the true edge is the trader's ability to remain unchanged while the market tries to provoke him. Can you sit still while others are chasing candles? Can you take a small loss without feeling personally offended? Can you follow your plan even when your last 3 trades were wrong? Because that is where fortunes quietly begin to separate. Emotional discomfort is often the first signal that discipline is slipping, and most traders miss it because they are trained to watch the chart, not themselves. I learned early that the market rarely sends you a telegram announcing danger. Instead, it nudges your emotions first. The price may still look orderly. Your setup may still appear valid, but inside you, something has begun to tighten. Have you ever noticed that feeling, the slight irritation when a trade hesitates, the quiet urge to interfere with a position that hasn't actually broken your rules? That is not random. That is information. And in many cases, it is more valuable than the next candle on the chart. A calm trader follows his plan almost mechanically. He enters where he said he would enter. He exits where he promised he would exit. There is very little drama in it. But the moment emotional discomfort appears, the mind begins to negotiate. It starts to whisper small exceptions. Maybe I'll give it a little more room. Maybe I'll size up just this once. These thoughts rarely announce themselves as danger. They sound reasonable. Professional even, but tell me honestly, how many costly trades in your history began with a small internal argument you chose to ignore? You see, discipline does not usually collapse in one dramatic decision. It bends first, and emotional discomfort is the pressure that causes the bend. A trader who feels perfectly at ease rarely violates his rules, but the one who feels slightly anxious, slightly impatient, slightly eager to be right, that man is already standing on unstable ground. The market has a peculiar way of amplifying whatever is already inside you. If you are patient, it rewards patience. If you are restless, it punishes restlessness. Emotional discomfort is often the first sign that the market has begun to press against your weak side. In my experience, there are several forms this discomfort takes. Sometimes it is the urge to check the chart every few seconds, even though your setup is based on higher time frames. Sometimes it is the impulse to move a stop loss that was perfectly logical just moments ago. Other times it is the sudden need to take a trade that was not part of your plan simply because the market is moving and you feel left behind. Have you felt that pull? The quiet fear of missing out that makes an average setup look better than it truly is. This is where many traders misunderstand the game. They believe the battle is between themselves and the market. In truth, the first battle is always between the trader and his own reactions. The chart is neutral. Price does what price does, but the trader's response to discomfort is what determines whether he is operating from discipline or from impulse. A professional learns to treat emotional discomfort as an early warning system. Not something to suppress blindly, and certainly not something to obey. Instead, it is something to observe. When that tight feeling appears in the chest, when the urge to act becomes stronger than the logic behind the trade, that is the moment to pause, not to accelerate. Yet most traders do the opposite. They speed up precisely when they should slow down. They add risk precisely when their judgment is becoming clouded. And the market, being the efficient teacher that it is, tends to charge full tuition for that mistake. There is also a money mindset component here that cannot be ignored. Traders who are properly capitalized and emotionally grounded experience discomfort very differently from those who are trading from need. If you are trading money, you feel you must win back quickly. Emotional discomfort will appear sooner and louder. The mind becomes less tolerant of normal market noise. Every small fluctuation begins to feel personal. Ask yourself, are you trading the chart or are you trading your P&L? Because when emotional discomfort is tied directly to your account balance, discipline becomes fragile. Small losses feel larger than they are. Normal drawdowns feel unacceptable. And in that state, the trader becomes highly vulnerable to abandoning his process at exactly the wrong time. I have always maintained that the market does not defeat the disciplined man easily. What defeats him is the moment he stops noticing his own internal signals. Emotional discomfort is not the enemy by itself. It is simply the messenger. The danger comes when the trader either ignores it completely or obeys it blindly. The skilled operator does something different. He becomes curious when discomfort appears. He asks himself quiet questions. Am I reacting to the chart or to my feelings? Has anything in my plan actually changed? Would I take this same action if I felt completely calm right now? These questions have saved many accounts from unnecessary damage. The danger begins when traders shift from executing plans to defending positions, and most men do not even notice when the shift occurs. It is subtle, quiet, almost polite. One moment you are acting like a professional operator, following a defined setup. The next moment, without ceremony, you are emotionally invested in proving that your trade must work. Have you ever caught yourself watching a losing position with more intensity than you watched it when you entered? That is often the first clue. When a trader is executing a plan, his attention is calm and measured. But when he begins defending a position, his focus becomes tense, almost personal, as if the market has insulted him. I learned long ago that the market has no memory and no opinions about you. Yet traders behave as though price movements are deliberate attacks on their judgment. The moment that belief creeps in, the trader stops thinking in probabilities and starts thinking in pride. Execution is clean business. You define the setup. You define the risk. You place the trade. And then you let the market do what it will. There is no need for emotional involvement. But defense. Defense is different. Defense is emotional. Defense is reactive. Defense is where discipline begins to bend. Tell me, when your last trade went against you, did you calmly accept the predefined risk, or did you feel the urge to manage it more aggressively than planned? That urge is where the trouble starts. A defending trader begins to reinterpret the chart to support his existing position. Resistance levels suddenly look weaker than they did before. Trend strength appears more convincing than it actually is. News that once seemed neutral now feels supportive. The mind, once objective, becomes a skilled lawyer arguing in favor of a trade that may no longer deserve the defense. This is not a small psychological shift. It is one of the most expensive habits a trader can develop. Because once you begin defending a position, your risk management quietly changes. Stops that were firm become temporary. Position sizes that were calculated become negotiable. Timeframes stretch. Rules soften. And all the while, the trader tells himself he is simply being flexible. But the market does not reward flexibility when it is born from emotional attachment. In my own operations, I noticed that the most profitable trades rarely required much defense. They worked with relatively little friction. Price behaved in a manner consistent with the original thesis. When a position required constant monitoring, constant adjustment, constant emotional energy, that was often a sign the trade was not as strong as it first appeared. Have you noticed how exhausting it feels to babysit a bad trade? That fatigue is not accidental. It is your judgment under strain. The professional understands something very clearly. Once you are defending, you are no longer trading at full clarity. Your decision-making bandwidth is compromised. You are reacting instead of observing. And in markets, reaction without structure is a costly habit. There is also a deeper money principle at work here. Traders who are focused on long-term wealth building treat each position as one of many probabilities. No single trade carries emotional weight, but traders who are overly attached to short-term outcomes tend to defend positions aggressively because each trade feels like it must succeed. This is why proper sizing is not just a mathematical decision, it is a psychological safeguard. When a position is sized correctly, it is easier to remain objective. Losses are tolerable, decisions remain clear. But when a trader risks too much, defense becomes almost inevitable. The mind begins searching for ways to avoid the pain of being wrong, and discipline starts to erode from the inside. Let me ask you something directly. When you move a stop further away than originally planned, are you managing risk or managing discomfort? Most traders know the honest answer. The charts themselves often reveal when traders as a group have shifted into defensive mode. You will see choppy behavior, failed breakouts, emotional spikes followed by reversals. The market is a mirror of human behavior at scale. When many participants are defending instead of executing, price action becomes less clean and more erratic. But your primary job is not to diagnose the crowd. It is to monitor your own behavior with ruthless honesty. I found it useful to ask a simple question whenever I felt tension rising in a position. Would I open this exact trade right now, at this price, with this information? If the answer was no, then I had no business defending it. That single question has prevented many traders from turning manageable losses into account damage. Execution requires preparation and calm. Defense thrives on urgency and emotional noise. One builds equity steadily, the other quietly erodes it. And here is the part most traders learn too late. The longer you defend a weak position, the more your future decisions become distorted. Your focus narrows. Your patience shrinks. You begin scanning the market not for the best opportunities, but for anything that might rescue the current trade. At that point, the market is no longer your playing field. It is your courtroom. Position size creep is one of the earliest measurable signs of lost control, and the market does not need to guess when it happens. The numbers tell the story plainly. A trader may believe his discipline is intact, his strategy unchanged, his mindset steady. But the position size, that quiet little figure in the order box, often reveals the truth long before the trader admits it. I have always said that the tape exposes everything eventually. But before the tape exposes you to the world, your own position sizing exposes you to yourself. It is the cleanest mirror of your emotional state, because when judgment is clear, size remains consistent. When emotions begin to interfere, size begins to drift. Have you ever noticed how easy it is to justify a slightly larger position after a loss? It rarely feels reckless in the moment. It feels logical. The setup is strong. This one looks cleaner. I just need to make back a little ground. That is how the creep begins. Not with a dramatic leap, but with a small adjustment that feels harmless. The dangerous part is that the chart may still look perfectly valid. Your entry might even be technically sound. But the size you attach to the trade is no longer aligned with your plan. And in trading, misalignment is expensive. When I was younger in the game, I learned that consistency in position sizing is one of the few things fully within a trader's control. The market decides the outcome. The market decides the timing, but the trader decides the exposure. And when that exposure starts expanding without clear, pre-planned reason, it is rarely a sign of confidence. It is usually a sign of pressure. Tell me honestly, when was the last time you increased your size purely because your written rules told you to, and not because you felt an emotional push to do so? Most traders cannot answer that cleanly. Position size creep often appears in predictable moments. After a string of losses, when the trader feels behind. After a strong winning streak, when the trader feels invincible. During slow markets, when boredom begins to whisper. Or during fast markets, when excitement begins to shout. In each case, the trader believes he is responding to opportunity, but more often he is responding to emotion. This is why the professionals treat size as a fixed business decision, not a mood-based adjustment. They know that the moment size becomes flexible without structure, the entire risk model begins to weaken. There is also a subtle psychological trap here that many overlook. Larger positions create stronger emotional reactions to normal price movement. A pullback that would have felt routine at proper size suddenly feels threatening. A minor fluctuation begins to command attention. The trader starts watching every tick more closely, not because the chart demands it, but because the exposure is now uncomfortable. Have you felt the tightening in your chest when a trade moves slightly against an oversized position? That feeling is not random. It is the direct cost of excess exposure, and here is where the damage compounds. Once emotional intensity rises, decision quality often falls. The trader becomes more likely to interfere with the trade. Stops get moved. Exits become premature. Or worse, losses are allowed to grow because the trader is too uncomfortable to act decisively. What began as a small sizing deviation now begins to distort the entire trade management process. From a wealth-building perspective, this is particularly dangerous. Long-term capital growth depends on controlled, repeatable risk, not bursts of oversized exposure, not emotional surges of conviction. The traders who last in this business understand that survival comes first, consistency second, and only then does meaningful compounding begin. Yet many traders quietly sabotage this process by allowing size to expand during moments of emotional heat. In my own work, I learned to treat any unplanned increase in size as a red flag, not a sign of courage. Because the market has a way of humbling traders precisely when they feel most justified in pressing harder. It is almost uncanny. The moment a man believes he has special clarity is often the moment his objectivity is most compromised. There is also the matter of identity. Traders who tie their self-worth too closely to recent performance are especially vulnerable to size creep. After losses, they feel the need to recover quickly. After wins, they feel pressure to capitalize aggressively. In both cases, the position size becomes a tool for emotional regulation rather than risk management. Ask yourself quietly, is your size determined by your plan or by your recent feelings about the market? Because the difference between those two answers can determine whether your account grows steadily or suffers unnecessary volatility. The market does not punish traders for being wrong occasionally. It punishes them for being wrong with too much size. Small, controlled losses are the cost of doing business. Large, emotionally driven losses are often the cost of lost discipline. The best traders monitor their own behavior as closely as the charts, and that is not philosophy. It is survival. Anyone can learn to draw lines on a chart. Anyone can memorize patterns and indicators. But very few men are willing to watch themselves with the same cold objectivity they apply to price. And that, more than any secret setup, is where the real separation begins. I learned early that the market is not just a test of analysis. It is a test of consistency under pressure. The chart tells you what price is doing. Your behavior tells you what you are becoming. And if you fail to watch the second one carefully, the first one will eventually cost you money. Have you ever reviewed a losing streak and noticed that your entries looked different than usual? Not dramatically wrong, just slightly rushed, slightly forced, slightly outside your best standards. That is exactly the kind of shift the professional learns to detect early. Because poor trading rarely begins with one reckless decision. It begins with small behavioral drift. The disciplined trader keeps records not just of wins and losses, but of his own conduct. He knows how long he typically waits between trades. He knows how often he checks the charts. He knows what calm decision-making feels like in his own body. These are not soft observations. They are operational data. When behavior begins to deviate from baseline, the professional pays attention. You see, the chart is only half the battlefield. The other half is internal, and the internal side moves faster than most traders realize. Impatience creeps in. Confidence fluctuates. Attention narrows. A man who does not observe these changes is trading blind in one eye. Tell me, when you open your trading platform, do you only scan for setups, or do you also quietly assess your own state of mind? Most traders skip the second check entirely. They assume that because the market looks the same, they themselves are operating the same. But that assumption has emptied many accounts. A trader who is slightly tired, slightly frustrated, or slightly overconfident does not process information the same way he does on his best days. The difference may be subtle, but in a probabilistic business, subtle differences compound quickly. I found that my best periods in the market were not just when my method was aligned with price action. They were when my internal state was steady, calm hands, clear thinking, no urgency. When those conditions were present, execution felt almost routine. But when I ignored my own internal noise, mistakes began to cluster. Have you noticed how trading errors often come in groups rather than isolation? That clustering is rarely random. It is behavioral momentum. Once discipline weakens slightly, the next decision becomes easier to compromise. The trader who does not monitor himself in real time often realizes the damage only after several trades have already gone off course. The professional avoids this by building self-observation into the process itself, before placing trades, during trades, and after trades, not in an emotional or dramatic way, but in a quiet, clinical manner, almost like a pilot scanning instruments. Because trading is not just about being right, it is about remaining stable while uncertainty unfolds. There is also a direct connection between self-monitoring and wealth building. Long-term capital growth depends on repeatable behavior, not occasional brilliance, not bursts of perfect analysis. Repeatable behavior, and repeatability requires awareness. If your execution quality varies wildly from week to week, your equity curve will likely do the same. But if your behavior remains tight and consistent, the mathematics of probability begin to work in your favor over time. Ask yourself something plainly. Could an outside observer watch your last 20 trades and clearly recognize your system? Or would they see emotional fingerprints all over the decisions? That question makes many traders uncomfortable. Because the truth is, most traders believe they are following their plan more closely than they actually are. Memory is selective. Ego is protective. Without deliberate self-monitoring, the mind quietly edits the story in its own favor. A trader may think he is being disciplined while the data tells another story entirely. That is why serious operators keep journals, screenshots, and behavioral notes. Not for vanity, for calibration. The goal is not to prove you are right. The goal is to detect drift early, and drift always leaves clues. Maybe your trade frequency increases without a clear reason. Maybe your average hold time shortens. Maybe you start entering slightly earlier than your rules specify. None of these changes seem dramatic in isolation. But together, they form a pattern. And patterns, as you well know, tend to persist until consciously corrected. The market is remarkably efficient at exploiting unmonitored behavior. It does not need to know your strategy. It only needs you to become slightly inconsistent. That is often enough. In my experience, the traders who endure are not the ones with the most complex systems. They are the ones with the highest self-awareness under pressure. They know when they are sharp. They know when they are forcing trades. They know when their patience is thinning. And most importantly, they are willing to step back when the internal readings begin to flicker. Patience is a capital preservation tool, not just a personality trait, and most traders misunderstand that point until the market charges them for the lesson. They treat patience like a virtue you either have or you don't, something soft, something optional. But in this business, patience is as practical as a stop loss. It is one of the few defenses a trader controls completely. I learned long ago that the market pays the man who waits and penalizes the man who must act. That difference is not philosophical. It shows up directly in the equity curve. Because every unnecessary trade carries risk, friction, and emotional wear. And those costs, small as they seem, accumulate quietly. Have you ever reviewed your trades and realized that many of them came from mediocre conditions? Not from your best setups, but from moments when you simply felt the need to be involved. That is where patience was missing. The impatient trader often believes he is being proactive. He feels productive, busy, engaged with the market. But the market does not reward activity. It rewards selectivity, and selectivity is impossible without patience. From a chart reading perspective, the difference is easy to see once you know what to look for. Clean trends, well-formed breakouts, and high-quality pullbacks do not appear every hour. They appear in clusters, separated by long stretches of noise, The trader who lacks patience begins to treat the noise as opportunity. He forces entries inside choppy ranges. He anticipates breakouts before they are confirmed. He trades movement instead of structure. Tell me honestly, how many of your losing trades began in conditions that were merely good enough? That phrase has probably cost traders more money than outright mistakes. The professional understands that patience protects capital in two distinct ways. First, it reduces exposure to low probability trades. Second, it preserves mental clarity for the moments that truly matter. Because trading is not just a numbers game. It is also an attention game. Your focus is limited. Your emotional bandwidth is finite. When you scatter it across too many marginal trades, your performance on the high-quality ones often suffers. I found that my most profitable periods were often the quietest in terms of activity. Fewer trades. Longer waiting periods. Cleaner execution when the moment finally arrived. It felt almost too simple at times, which is precisely why many traders resist it.